At first, nothing looked wrong. Silver prices were calm, too calm, hovering, drifting, obedient. For years, silver had behaved like a well-trained animal, rising just enough to keep investors interested, falling just enough to crush momentum. Every rally died, every breakout failed, every shortage somehow resolved itself. And then, quietly, China stopped playing along. No press conference, no announcement, no warning, just action. And by the time Western banks realized what was happening, the silver market was already broken. To understand how China crashed the silver market, you first have to understand a disturbing truth. The silver price you see is not set by physical silver. It is set by paper contracts. For decades, the global silver price has been controlled by futures markets in London and New York, primarily the COMEX and LBMA systems. These markets trade promises of silver, not silver itself. For every 1 ounce of real silver, there are anywhere from 100 to 400 paper claims, depending on the estimate. This worked for one reason only. Almost no one ever asked for delivery. As long as traders rolled contracts forward and settled in cash, the illusion held. But China understood something Western markets preferred to ignore. Paper markets collapse the moment physical demand overwhelms confidence. And that's exactly what China targeted. China doesn't speculate. China accumulates. For more than a decade, China has been quietly absorbing real assets: gold, copper, uranium, oil, farmland, and especially silver. Why silver? Because silver is not just a precious metal, it is a strategic industrial metal, a critical input for solar panels, EVs, military electronics, AI chips, and medical technology. And unlike gold, it is consumed, not stored. Over 50% of all silver mined annually is used up in industrial processes and never recovered. China knew this math would eventually matter. So instead of chasing price, China chased supply. While Western traders played derivatives games, China built something else entirely. The Shanghai Gold Exchange, SGE. Physical settlement requirements, delivery-based contracts, transparent vault withdrawals. Unlike COMEX, where delivery is optional, Shanghai demands metal. And here's the key difference. You cannot suppress prices forever in a delivery market. China encouraged domestic manufacturers, solar producers, and state-linked firms to source silver directly through Shanghai channels. At the same time, China increased strategic silver stockpiling, reduced silver exports, absorbed supply quietly through state-owned entities. No headlines, no noise. Just a steady drain on global physical inventories. By late 2024 and accelerating through 2025, something strange started happening behind the scenes. LBMA vault inventories began falling faster than expected. COMEX registered silver declined month after month. Lease rates quietly spiked. Refiners reported longer delivery delays. But spot prices barely moved. Why? Because Western banks were dumping paper silver to cap price, creating the illusion of abundance while physical supply vanished. This was the fatal mistake. They assumed China would blink. China did not blink. The breaking point came when physical delivery requests surged simultaneously from multiple directions. Asian manufacturers, sovereign-linked buyers, industrial users refusing cash settlement, Eastern refiners bypassing London entirely. Suddenly, bullion banks faced an impossible situation. They had sold far more silver than existed. Normally, this is manageable, because only a fraction asked for delivery. This time, too many did, and the math didn't work. Gold is heavily guarded. Gold has central bank backstops. Gold is politically sensitive. Silver is different. Silver was treated as a poor man's metal, an industrial commodity, a manageable side market. That complacency made silver the perfect pressure point. China didn't need to crash gold. They just needed to break confidence in paper pricing. Silver was the crack in the dam. As physical silver tightened, Western banks faced cascading risks. Short positions ballooned. Delivery obligations stacked up. Margin requirements increased. Counterparty trust evaporated. This is when the quiet signals appeared. Dealers halted retail silver sales. Premiums exploded even as spot prices stayed stable. Delivery times stretched from days to months. Some ETFs quietly changed prospectus language. These were not coincidences. They were stress fractures. China didn't need silver to spike immediately. They needed control. By securing long-term supply through mines, through refineries, through bilateral trade agreements, through physical settlement systems. China ensured that when the paper market finally failed, the real metal would already be in their hands. That is how you crash a market without firing a shot. This wasn't a price event. It was a structure event. China didn't attack silver prices. They attacked the mechanism that sets the price. And once confidence in that mechanism cracks, prices don't rise smoothly. They gap. They reprice violently. They transfer wealth. There is always a moment, quiet, unannounced, invisible to the public, When power shifts hands, not when prices explode, not when headlines scream, not when politicians speak, but when institutions stop trusting each other. That moment arrived in the silver market long before the public noticed anything was wrong. Inside bullion banks, risk committees were no longer asking, "Can we manage this?" They were asking something far more dangerous. What if we can't deliver? Because once that question appears, the market is already broken. Western bullion banks, JP Morgan, HSBC, Scotia, BNP Paribas, Standard Chartered, had built the modern silver market on a simple assumption. Most contracts would never settle physically. Cash settlement would always be accepted. Confidence would always outrun reality. This assumption had held for decades, until China forced reality back into the equation. By late 2025, internal stress signals were flashing, unusually high physical delivery requests, refiners demanding prepayment, vault inventory reconciliation delays, lease rates spiking quietly, interbank hesitation on silver swaps. None of this made headlines, but inside the system, alarms were sounding, because bullion banking only works when metal flows freely, and suddenly, it wasn't. Paper silver is leverage stacked on leverage. A single ounce of silver could be sold, rehypothecated, leased, used as collateral, resold again. Each layer assumed the one beneath it existed, but China's physical drain exposed a terrifying truth. The base layer was missing. When industrial buyers refuse cash settlement, bullion banks faced a nightmare scenario: settle in cash, admit shortage, delay delivery, signal insolvency, source metal, drive price higher against their own shorts. There was no clean exit. Every path led to panic. Confidence didn't collapse publicly. It collapsed between institutions. This is critical to understand. Markets don't fail when prices rise. They fail when counterparties stop trusting promises. By early 2026, banks began shortening settlement windows. Collateral requirements quietly increased. Physical premiums detached from spot prices. Interbank silver liquidity thinned dramatically. These are pre-crisis signals. The same signals that appeared before: the 2008 credit freeze, the 2020 Treasury market seizure, the 2023 regional bank collapse. Silver was now joining that list. Retail investors noticed something strange first: not prices, availability. Out-of-stock signs appeared everywhere. Dealers halted sales entirely. Delivery times jumped from days to months. Premiums exploded 30%, 40%, 70% above spot. The message was clear: spot price was no longer real. This is the moment markets decouple, when physical reality ignores financial fiction. And when that happens, wealth transfers begin. Silver is not gold. Gold has central bank backstops, political sensitivity, strategic reserves. Silver has none of those protections. Silver was treated as a manageable derivative market, a hedge fund playground, a price-suppressed industrial input. That made it the weakest link. When pressure mounted, there was no central authority to step in, only balance sheets, and balance sheets were fragile. Western banks were massively short silver, not because they hated silver, but because shorting silver suppressed volatility. Suppressed volatility stabilized industrial costs. Stabilized costs supported inflation narratives. Silver had been a policy tool, not just a commodity, but short positions work only under one condition: you can always roll them forward. China ended that assumption. Once physical delivery requests rose, rolling became impossible. Losses began compounding. As silver demand tightened, margin requirements quietly rose. This created a feedback loop: rising margin, forced liquidations, market instability, higher margins. Banks had to post more collateral, often treasuries or cash, at the worst possible time. Silver stress began bleeding into repo markets, treasury liquidity, dollar funding costs. This is how a metal becomes a systemic threat. No official announcement was made, but actions spoke louder than words. Some ETFs altered prospectus language. Cash settlement clauses were emphasized. Authorized participants slowed creations. Inventory audits were delayed. Transparency quietly declined. These are not normal behaviors. These are defensive maneuvers. This confuses many people. If silver was broken, why didn't prices skyrocket instantly? Because price explosions happen after trust collapses, not before. Before collapse, suppression intensifies, paper supply increases, volatility is crushed. This creates the illusion of control, but it also magnifies the eventual move. Silver doesn't trend smoothly when it breaks, it gaps. This is where the real story lies. When paper markets fail, wealth transfers in 3 stages: China, industrial users, sovereign entities, long-term physical holders. They accumulated quietly, cheaply, patiently. Banks scramble for metal, shorts cover at rising prices, liquidity evaporates, losses concentrate, spot price disconnects, physical price resets, late entrants chase. By the time the public notices, The transfer is complete. Bullion banks with synthetic exposure, paper ETF holders who trusted redemption, speculators trapped in cash settlement, industrial users without secured supply. Losses weren't just financial, they were reputational. Trust, once lost, never fully returns. China, with secured physical inventory. Eastern exchanges using delivery pricing, long-term physical holders. Industrial players with locked contracts. They didn't trade silver, they owned it. That distinction matters more than ever. Silver is thinner, silver is smaller, silver is consumed, silver is understocked. That makes it violent when it moves. Gold moves in trends, silver moves in shocks. When confidence broke, silver didn't ask permission, it repriced itself. Silver's repricing wasn't just about metal, it was about money. Trust in paper claims weakened, trust in settlement systems declined. Confidence in fiat promises eroded. This pushed capital toward hard assets, energy, strategic commodities. Silver was the signal, not the destination. China didn't want higher silver prices. They wanted pricing power. By forcing delivery, they weakened Western price control, strengthened Eastern settlement credibility, positioned Shanghai as a price-setting hub. That is not a market move. That is a monetary maneuver. This has happened before, London losing silver dominance to New York, Britain losing gold dominance to the US, the gold window closing in 1971. Each time the pattern was the same. 1. Paper overreach. 2. Physical constraint. 3. Confidence collapse. 4. Wealth transfer. Silver is simply the latest chapter. This wasn't manipulation, this wasn't conspiracy, this was math. You cannot sell infinite paper claims, suppress price forever, ignore physical demand. Eventually reality arrives. China just made sure they were waiting when it did. Once a market breaks structurally, it never goes back. Silver will not return to. Unlimited paper leverage, endless suppression, synthetic abundance. The rules have changed, and most participants haven't realized it yet. Silver didn't collapse the system, it revealed it. When small markets break first, it's a warning. Because the same mechanics exist in bonds, currencies, derivatives, sovereign debt. Silver was the crack. The dam is still under pressure. Every great wealth transfer looks invisible at first, then obvious, then irreversible. By the time it's obvious, it's too late to position. Silver didn't just panic Western banks. It exposed the limits of paper power. And once those limits are known, the world never trades the same way again.